Imagine a ticking time bomb. Only this one isn't buried under a city street or hidden in a briefcase. It's woven into the very fabric of the global economy, and its countdown is echoed in every news ticker flashing updates about the US national debt. 40 years ago, in 1980, that debt per American household was a manageable $39,000. But today, in 2024, it has surged to a staggering $260,000 per household, or $484,000 for every child in the nation. The total US debt has now breached an eye-watering $35 trillion, $10 trillion more than just 4 years ago. In this year alone, over $1 trillion will be spent on interest payments alone, more than the entire defense budget and almost equal to the GDP of Switzerland. Why does this matter? Because these aren't just numbers on a balance sheet. They signify a growing crisis that threatens to ripple across the entire world economy. If the US can't pay its debts, it won't just be an American problem. It will be a global catastrophe. But how could such a crisis unfold? And what does it mean for everyone else? In this analysis, we'll break down the US debt situation, exploring both possible futures, one optimistic, one grim. We'll uncover who holds America's IOUs, why the debt is growing at an alarming rate, and what could potentially be done to avert a full-blown financial meltdown. This isn't just about the money. It's about the future stability of the world's largest economy. The US government operates much like a household with a credit card. If it spends more than it earns, it borrows to cover the gap. But unlike a regular household, the government can keep borrowing up to a point. When those debt payments grow faster than the country's income, a crisis begins to brew. Currently, America's debt-to-GDP ratio stands at 120%, meaning it owes more than it produces in an entire year, a historical peak that even surpasses the debt level seen during World War II. It took 205 years for the US to reach $1 trillion in debt, a milestone it hit in 1981. Today, $1 trillion is just the yearly cost of servicing the interest. Like a credit card with an astronomical interest bill, America is maxing out its borrowing limit. Over the years, wars, tax cuts, stimulus packages, and economic downturns have fueled this debt. Now, the debt's growth is outpacing tax revenue, leading to fears of a sovereign debt crisis, a term once reserved for struggling economies, but now ominously linked to the United States.
Is that we are at a point in which we are borrowing money to pay debt service. And there is a process by which when you keep having debt growth faster than income growth, then that means that you have debt service encroaching on your spending. That's the same for the government as it is for us. And as that happens, and you want to keep spending at the same level, there is the need to get more and more into debt. And the way that works, it's like it accelerates. We are at the point of that acceleration.
So how could a US debt crisis affect the world? Let's dive into two potential outcomes. One where the US weathers the storm, and one where it sinks further into turmoil. The positive outcome. Number 1. Safe haven status. Even in a crisis, US assets might still be seen as a safer bet compared to other nations, potentially attracting investment flows that could stabilize the economy. Number 2. Stimulus measures. The government could enact large-scale fiscal stimulus, injecting money into the economy and stabilizing markets. This might lead to a weakened dollar, but also a boost in exports, making American goods more competitive on the global stage. Number 3. Recovery through innovation. If the US can leverage its innovative capabilities, it could emerge from a debt crisis stronger. Post-World War II, a similar scenario unfolded where a weakened dollar led to an economic boom. 4. Increased domestic investment. Higher interest rates could encourage Americans to invest in government bonds, providing a lifeline to a government in need of funds. The negative outcome. Number 1. Loss of confidence. If the US defaults, it could spark a crisis of confidence, driving investors to flee US bonds. This could lead to skyrocketing interest rates and a market crash reminiscent of economic collapses seen in countries like Argentina. Number 2. Higher borrowing cost. Businesses and consumers would face steep borrowing costs, stifling growth and leading to reduced spending. Number 3. Global market turmoil. A US debt default would send shock waves through global financial systems, disrupting trade and creating widespread uncertainty. Number 4. Inflation and overreaction. The Federal Reserve could try to counteract a debt crisis by printing money, but this would lead to inflation and erode trust in US bonds, creating a vicious cycle of economic instability. If the US can't meet its debt obligations, the repercussions will ripple across the world. The US bond market is enormous, larger than the stock market. A default would be akin to throwing a wrench into the gears of the global economy. Bond interest rates would surge, and with them, borrowing costs for countries around the world. This could trigger inflation, higher mortgage rates, and economic slowdowns, affecting everyone from large corporations to small business owners. Who holds the US debt? The list of creditors is diverse, ranging from other countries like China, Japan, and the UK to commercial banks, pension funds, and private investors. The US even owes itself money through various governmental programs. If the US were to default, these stakeholders would lose massive sums, causing a domino effect that would be felt in economies around the world. What can be done? There are 4 main strategies. Number 1. Economic growth. The most hopeful scenario is a robust economic boom. If America can innovate and boost productivity, higher tax revenues could help manage the debt. Number 2. Printing money. This option would mean flooding the market with cash to pay off debts, but it risks hyperinflation, a dangerous path that could devalue the dollar. Number 3. Raising taxes. While increasing taxes would raise revenue, it's politically unpopular and could further strain a fragile economy. Number 4. Cutting spending. Arguably the most feasible option, reducing wasteful spending could save hundreds of billions. However, this requires political will, which has been sorely lacking. The future is uncertain. America has navigated financial crisis before thanks to the strength of the dollar. But today, the stakes are higher. If the US doesn't take a decisive action, the risk of a debt crisis could spiral into a full-blown economic disaster, dragging the global economy down with it. It's a race against time. The world is watching, and the stakes have never been higher. Will America act before the ticking stops?